Welcome, everyone. Today, my guest is Lead Analyst Logan Mohtashami to talk about inflation, bond yields, mortgage rates, and pending home sales. Logan, welcome back to the podcast.
It is wonderful to be here, Sarah.
Wonderful to be here with you. It is Friday, June 30th when we are recording this. It's going to go live on July 3rd. So tell me, Fridays are always big economic days. What's the big news today?
Well, today the core PCE data came out, actually, the personal consumption expenditures data that the Fed wants to get back to the 2% level. That's their target inflation data, not so much the consumer price index that people love to use. But here, the year-over-year data is cooling down noticeably, but the core data is being a little bit more sticky than they would like. And I think one thing that I talked about this morning is that people have to realize that the Fed is actually not looking at core PCE with the housing aspect of it. So they're kind of tracking service inflation at this point. And it's confusing because you see these headline numbers being down year over year. And by the way, I just want everyone to realize that the growth rate of inflation is falling down on its own without a job loss recession. So for every single one of you that have said we need 6% plus unemployment rates to bring down inflation, most of you are boomers and you're angry because you should not be pushing a job loss recession, especially above 6%, to bring the growth rate of inflation down. That is an archaic way of looking at economics. The history of pandemics have always been inflationary at first, and then the disinflationary factors after. And any person on the Federal Reserve that is advocating a job loss recession at this point for the growth rate of inflation, you should be fired on the spot, or you should quit. Go with the job openings data. There's no more debate on this topic. The growth rate of inflation has not been accelerating since last year. The wage inflation data has been going down for 18 months now. There's nothing here that requires a big job loss recession, especially 2% above where where the trend is. So hopefully that topic is over with now. This is not the 1970s, nor will it ever be the 1970s, nor will the rent inflation boost like the 1970s. So I think today was an important day on that aspect. It's going to take some time, but again, we kind of see where the data lines is heading to, and all a positive trend, right? Get the growth rate of inflation down. The whole 6 recession red flag model was, there's 2 things that need to happen to be positive at this stage. Number one was the growth rate of inflation falling. That happened, especially with energy prices and gas prices. Last year, we all saw, energy spike up, gas prices spike up, wheat prices went parabolic after the Russian invasion. Those things have calmed down. That's a positive for the U.S. And hopefully now we can move to the next stage of the discussion of the Fed and not have these certain people constantly talk about, well, we need a recession. Unemployment rate 6-7%. That is not an effective economic model at this point, and we are good to go, and we don't need to push anything at this point. That conversation should be done today.
So really, from your perspective, they're just using an old playbook, right? It's like they're fighting the last war with those battle strategies where we do not need a job loss recession at this point.
Sarah, it's old men. It's just old guys. I'm just telling you, it's old guys who say we need. I mean, the fact that people were advocating, unemployment rates 2% above trend and with duration to bring down inflation, no, it's just not. If I thought inflation could actually keep on going up higher, we create a model based off of that and then we run with it. And none of that happened, right? Because again, the history of global pandemics are very inflationary early on, and then the disinflation factors happen, especially with rents. And we're seeing that happen in its course. Now, whether you want to argue you want a 2% or 4% or 3% core PCE, fine, have that argument. But the notion of, we need to break the labor market. I mean, even Jay Powell talked about this week. Labor market's too tight. Labor market's too tight. We have to. You don't need to. You just need to endure. Right. That's the term that I've used. At some point you have to just endure and move it along and let the supply factors kick in, and that's a positive, right? We will no longer tolerate people advocating job loss recessions in this country, right? And I think that group should be fought against every single time for our old archaic way of looking at inflation, especially with a global pandemic. I mean, you look at the history of the 21st century, we could barely even keep core PCE at 2%. It was down, like half the time was under 2%. So uh, the supply issues are getting better. Give it time, and we can move on. But clearly, we're almost in July the 4th, and there's no acceleration. There's nothing. There's some stickiness in core in goods and services, but outside of that, the reacceleration that we've seen just can't happen. And again, if you believe in the reacceleration, you believe in a massive housing boom or rent inflation taking off, and that's not the case. And you could see this even in the core PCE data. The shelter factor, just like in CPI, is now slowly starting its 12-month descent in that growth rate. So I think it's a very positive in that light. And in fact, I even tweeted this out. Anybody who's advocating 6% unemployment rates, I did a very, very pleasurable emoji giving my disgust to that kind of talking point.
So let's talk about bond yields and mortgage rates, because boy, they are back up where, it's so bad for housing to have mortgage rates over 7%. I know it's within your forecast. I know all that. I know that to you, you might say, oh, it looks perfectly normal, but it is just devastating to our industry. So let's talk about bond yields and mortgage rates.
So when we do the weekly tracker, there's one constant theme: claims data. Every Thursday, jobless claims, jobless claims, jobless claims. And what occurred is, on a technical basis, the 10-year yield is slowly rolling over. But what happened on Thursday morning is jobless claims took a big dive under, which means that that's very bullish for employment. And whenever you see a big number in jobless claims, whether up or down, you should kind of somewhat ignore it. But what occurred was bond traders were not in that position at all. So they sold first right away. You could see this by the velocity of this. I know the GDP numbers were revised, but listen, it was all about jobless claims. And this is why at this point of the cycle, claims over jolts job openings data. So the whole 2023 bond yield forecasts and mortgage rate forecasts is actually not based on the growth rate inflation. Growth rate inflation is falling. It simply cannot sustain itself at, CPI was at 8-9%. But here, the labor market is still doing its thing. We call, what was it, the honey badger labor market, we called it last year. The structural dynamics are different now than what we saw after 2008. So the job openings are 10 million. So, we wrote that early in the recovery. So it's to get to 323,000 on the 4-week moving average. That's going to take something. And I think the 10-year yield just shot up right away, and mortgage rates just shot up. So the interesting aspect still, and I think this is the main story for 2023, the spreads have gotten worse since the banking crisis. So my 7.25 peak level that was tied to the 10-year yield being at 4.2%. That actually can go up even more if the 10-year yield gets back to the high point of the range. And right now we're at 385, and I try to show these charts on my Instagram and try to show these short-term rollovers on the 10-year yields. And as long as that is still in play, that's rates can't. We say this in a lot of the podcasts. Things could be worse than where they are now. And as long as that doesn't break out higher, we're kind of in the upper range of what we've seen this year. But just for me personally, it looks perfectly fine, except for the spreads. The spreads getting worse after the banking crisis is the big story of 2023. And it's the housing market has stabilized, in terms of the demand, just because we're at historical low levels. And I was telling another economist, I said, if you actually look at existing home sales, you adjust it to the population and the actual civilian employment, it's the lowest levels of sales ever. right? Because we have over 156 million people working. The pending home sales data fell month to month. That looks perfectly fine with where the ranges I'm looking for this year. But the existing home sales market doesn't have the benefits of the new home sales market. New home sales are like, they're like taunting, the new home, the people that are in the new home industry. Hey, listen, we could get sub 6% rates all day long, and I mean, there's a part of me that enjoys that because they've been at such a disadvantage in the previous decade versus the existing home sales market. But now they have a few levers they can pull, and but the existing home sales market is still limited to a degree, and higher rates just doesn't help that demand get better. Lower rates will, but for now, we're kind of still in that range, and jobless claims haven't broken yet. And this is why every week on the tracker, we talk about claims, 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 claims. This is the first week that we actually saw like a noticeable kick in the bond market because of jobless claims data.
So, to your point, you and I were talking about the existing home market versus the new home market. And new homes now account for like 30% of all homes sold, which just shows you how few homes are being sold, because it's not like that's a giant market. It's not like, oh, we've got millions of new homes that we could sell.
No, it's a good a, a good reference to this is, like in 2019, where we're like near 6 million home sales bought. The new home sales market was around 700,000, around there. So
Wait,
it's
so out
not a
of
very
6 million, it was
yeah
700 out of
yeah out
6
of 6
million
million, like
total?
700,000 were new homes. So it's not it hasn't been a big part of the market for a very long time. But here it's advantage disadvantage. The builders actually have an advantage where they can provide lower rates. They've already cut prices. They're doing things to move product. And imagine the US housing market with sub 6% rates for the existing home sales market. We got a glimpse of that on November 9th, December, January, where we saw mortgage rates head down toward 6%. Duration, right? Duration is always key. And we saw 3 months of positive purchase application data, gave us one of the biggest home sale prints ever recorded in history. Uh, that's why lower rates with duration is key, because then people can make choices, right? And I think that's the one dynamic about housing that people don't understand. People this year are starting to make plans for maybe next year for what they're going to do for housing. And uh, you don't just sit there and go, oh, honey, the 10-year yield broke a certain level. Mortgage rates are heading towards 6%. Should we go apply for a loan? No, dear, we have no game plan right now. What are you doing? But we have to rush to the market to get no. So you don't buy a house on a whim. I know this has been marketed at times, but lower rates with a longer duration is very positive for the existing home sale market. Where the new home sale market's like, hey, listen, rates are 7, doesn't matter, we can do this. They are pushing that lever, and it's very effective for them.
So when you look at the rest of the summer, so we're midpoint in the year almost, right? This is going to air on July 3rd. When you look at the rest of the year, do you see anything that could lower rates?
So again, the lower the bringing rates down is more based on the labor market. So the labor market has to crack, and it's not
So
cracking.
what affects that? I mean, like, so,
I mean,
we talked
that's
about the banking crisis and
well,
that's
here's
keeping.
a case. Here's if I had to present a model to people going out for the next 6 months, I would say, so what are factors that can make the economy grow slower? Number one, eventually student loan debt payments are going to be made. Okay, that's a negative. That's not a positive. Number two is the credit getting tighter, especially for small businesses. That is a negative. That's not a positive. Eventually, the interest expenses of households will limit the ability for consumption to grow. So you put three different variable factors in together, and toward the end of this year, you have something to work with. At least now, we're just basically moving this along. The savings rate is also much lower now than what it was before. So people have less savings. to work off of. So the accumulation of credit card debt with higher net interest payments and less savings means that the future consumption is limited to a degree for certain households. Those are things that you can put into a model and think, okay, things can slow down later on. And I think that's part of the Fed's thinking in terms of, maybe pausing, or we're toward the end of the rate hikes, is that there's also a lag period between how much rate hikes you need to have versus how many uh, what is the full impact of these rate hikes over time. So there are variables out there, just not anything that are current right now.
So I was listening to NPR this morning, as I am wont to do, and one of the things that they talked about was that interest on credit cards now, the average is over 20%, which is crazy, crazy, crazy. I mean, if you are a household that puts things on credit cards and can't pay them off every month or don't pay them off every month, I mean, that's just like a huge tax, right? I mean, that's really eating into your what you can spend.
It's eating into future disposable incomes. It's just credit card utilization rates aren't very high. I know, one of the things I've seen over the last 11 years is that people think that nominal credit card growth is actually a bad thing. And that's actually how expansions keep on going, because people consume debt on credit. Nobody pays cash for everything. But the credit card utilization isn't anything big right now. So that's it. When credit card debt starts to go down, that's when you get to see the economic data start to get worse. So eventually, over time, it just eats into you. And one of the things that I talk about with very long expansions and very high short-term rates, people get to put more and more of their stuff on credit. If that builds up over time and that person loses a job, there's where you start to get bankruptcies and foreclosures.
Okay, let's talk about pending home sales, purchase apps. Let's look at some of that data. What do we see today with pending home sales?
So the pending home sales came out. It was a miss month to month, and when we got that really big existing home sales print early on in the year, I said, okay, you know what? I think that's the peak for this year. That was a very abnormal monthly sales print, one of the biggest I've ever seen in history, and that a lot of that had to do with the huge decline in demand last year, and then 3 months of purchase application data being positive into 1 year. So the velocity of that move is not normal. And then after that, said, hey, listen, I think that'll be the peak. So what we have to look is that existing home sales are trending at the lowest levels ever recorded in history versus the population. That's a fact. Anybody who wants to dispute that, no, it's not true. And we're still staying in that range, but purchase application data is not declining in a big fashion anymore. It's just stabilized. In the last 3 weeks, we've had positive week-to-week data. So the stabilization in data is still here, but that just means we're hovering at the low levels. When you get to see actual growth, every single week is positive. The year-over-year data is positive, and that trend growth comes on. That's why if you look at purchase application data from the bottom of 2014 all the way up to March of 2024, you saw that slow moving uptrend, right? We don't have that. So that means demand is just stabilized from a waterfall collapse and nothing else is happening. That's the authentic, real way to look at the data. Until that changes, we're just here. We're at a very low level base. And again, like we've always stressed, sellers are buyers, right? And if people cannot afford to move, they're not putting their home on the market to sell to buy another one. So until that dynamic changes, and what we have seen is after 2010, lower mortgage rates changes that dynamic. And until that becomes an authentic story of duration and time, let's say mortgage rates go down to 5.5%, but they stay between 5.5 and 6.25, not 6 to 7%. Then you could have something there, and then we'll see it in the forward-looking data. But the forward-looking data, to me, just talks about stabilization. This is why the theme is stabilization, stabilization. The new home sale market is different, right? Much smaller market rate, rates are lower for them. But the pending home sales to me is still sticking in that range. And, there's a better case to make that existing home sales could get below 4 million rather than get above 4.6 million. And that's kind of what the data shows. And I think it's just confusing for everyone, because naturally what occurs is people think, well, if demand collapses, inventory should skyrocket and prices should collapse. That's the volumes lead price theory, except the inventory data didn't go along with that. And that's why the internals of housing economics is different than let's say trading stocks. So the pending home sales looks about right. I just don't think there's much going on in housing outside of that one big report. But if it does, we get to see it in the purchase application data. But to me, it's, if rates get below 6%, especially that 5% level, you could have something. Last year, when rates got down to 5% for like 2 weeks, we saw some of the data line change, but that's not the case anymore. We're still 2% higher than that. So there's nothing in the data that says to me the existing home sales market is getting out of the 21st century lows in demand, considering there's 156 million people working. The concern I have, because the savagely unhealthy housing market is here, when rates fall, right, and inventory is this low, we get back into that kind of marketplace that I'm not a fan of. And it's just the lack of active listings is still here. Now, when mortgage rates went from 3 to 7% and we had the biggest home crash ever recorded in history, that dynamic meant that low inventory doesn't protect you because demand has fallen. Well, if demand stabilizes, that's not that big of a story. But if demand grows, what are we doing here? We're stuck. And that's a problem, because what happens if prices keep on rising? We're not, like, affordability isn't getting any better, right? Because it's not like home prices fell 20%. It's not like rates are falling. So we're still dealing with the affordability issue. It's just that in the United States of America after 1996, there's always been that 4 million home buyer base. And we haven't been able to break that with any duration. We didn't even do it that much in 2008. And we've kind of held the line here with higher mortgage rates. But it does become the same problem that I've been concerned about after 2020, or after the summer of 2020. Too many people chasing too few homes. And then also the Federal Reserve having some archaic way of looking at home price inflation and housing. And it's just, Sarah, I really have to have like an emergency meeting with them. Like, I got to get all the Fed presidents in a room and go, listen, let me explain to you what your archaic models of price inflation going into core CPI is not legit. Okay. So it's rent inflation. And where the one area that we do see some supply really coming in is in the apartment construction. And we just got to, I would get the Marines, Army, every man we can have, and ladies, to get those apartments up there and build them up as fast as possible. And then the growth rate of inflation would even be more tame, because supply defeats inflation over the long run. Demand destruction is only a short-term fix. And we saw what happened. The Fed tried to destroy the housing market and thought that prices would come down or something. The Fed reset, or whatever the people's assumption was on that, didn't work, right? Because sellers are buyers and everyone has a really good 30-year fix. And it's just savagely unhealthy, Sarah. And it's just like it's the worst. It's like I sit here and think about, this is like the one thing I thought, what if this actually happens in 2020 to 2024? What if we just get stuck in a low inventory? We can't budge that. And we do this, and it's midpoint of 2023. And I'm going to go through this whole 5-year period of mine that I've been waiting for a decade. And the nightmare scenario happens. And it's just one of these things it's not an easy fix like people think.
It's not, and it's especially savagely unhealthy if you're a first-time home buyer. Because first of all, I mean, you have less buying power than you maybe ever had because you have higher rates and home prices haven't fallen. And that's not going to get better anytime soon because you have, low inventory. And I know personally, I know tons of millennial people, my kids, their friends, all my nieces and nephews, of which there are 24, as we know. And as I'm telling them, and I feel
Wow,
like there's
you have
pent up
24
demand.
nieces and nephews?
I do. Yeah. Yeah. Absolutely.
I've got 2 cats, a goldfish, and a tortoise.
Listen, I come from a big family and then we all had a lot of kids. So yes, I because of that, I know a ton of millennials who are in that home buying age, and many of them have been, I mean, they've had to wait. They couldn't compete in 2021 and part of 2022, and then rates went up, and they're kind of shut out. So I know you don't like to think about the sideline buyers, but I do think
No,
there's
I
pent up demand.
there is a pent up buyer demand because the demand fell so fast, so quick because mortgage rates went up so much. So in that context, you can have like a sideline home buyer. The reason I never liked the sideline home buyer is because when home sales trends were trending normal, and then rates like went up or went down, people go, the sideline home buyer, and that goes into the honey, the 10-year
Right.
yield broke. Should we go buy a house? What are you talking about, Dan? We haven't even talked about buying. No, but the
No, but
10-year
these
yield
are
broke,
like,
and that doesn't work. Like people don't have that conversation. It's like today. Today, somebody said, again, this is just what some people think. Should a millennial be concerned about paying top dollar for a house? Maybe they should wait 10 years when the baby boomers downsize or die off. And I like told the person, hey, guys, do not have sex with women. Do not have kids. Do not even start a family. Just wait until the baby boomers die. Then start that process. If you can find a lady that will wait that long for you, and then you can buy a home. And then by the time you're like in your 50s, then you go, yay, I did it. I listened to a bunch of people on the internet that told us to wait. Yeah, people don't operate that way. And that's the thing, is that the dynamics of the millennials being this massive at this point in time in their first time home buying age. And the reason I talk about this is some of the charts that I show from the NAR. It shows you that baby boomers and older people don't finance their homes as much as younger people. Younger people are like an 86 to 95% financing of their homes. So when mortgage rates go up, they get disproportionately affected. So the Federal Reserve, the people that are their age are, hey, we got it. Those pesky kids are out of here, right? They're not bidding with us anymore. So we get to buy what we want. And it's tough. I mean, I feel for them just because I've been waiting for this period for so long. And if you look at the millennials, were the biggest home buyers in America, and they were the biggest home buyers in 2021. But when mortgage rates went up to 3 to 7%, there is no country for young men and women in this housing market. For older men and women, yeah, but it's savagely unhealthy, Sarah.
it is savagely unhealthy. Well, Logan, we're coming to the end of our time, but I did want to promo the fact that you and I recorded a special 4th of July episode of this podcast. Yes, we did it early, and we looked at, the factors that make the U.S. a really great place to buy a home, and what homeownership looks like here. What are some of the advantages of that? It's a very good episode, I think, and it's coming out on July 4th. We wanted to have something for people, so not only do they get to hear you today, which this will air on Monday, but on Tuesday and on Thursday this week. So
July the 4th, baby. July the 4th. I just want to remind everyone, the previous
we have
expansion was the longest economic and job expansion ever recorded in history. We had recession calls every single day during that period. Then COVID-19 came, and some of you people thought COVID-19 was your savior, that the collapse of the United States of America and the dollar demise and all that stuff. And we rebounded in 6 weeks. And the US economy is outperforming the world again. Why? Our demographics, our king dollar, our military, our people are much stronger and tougher than you think. So don't ever forget that America is great because of its people, not just because of King Dollar and everything, but us as a nation. Our demographics is our muscle. We have a lot of younger people, millennials and Gen Z. Other countries don't have this. They don't have replacement workers or consumers. That's the benefit of the US. That's why housing broke out before COVID hit us. That's why our recoveries are good. I keep on showing this because a lot of times people show these charts and they go, oh my God, why is the US outbreaking? And I just put the population charts, and Japan's dying and Europe is going down and China's in, but US, we're doing good.
yes, more of this same energy and talking points. Although we go into quite a few things. So listen to the special July 4th podcast, and hope everybody has a great July 4th. And Logan, thanks for being on.
Great July 4th. And just remember, all American bears have failed since 1790. Join that list if you want to. Go ahead.
our listeners are not among those. So anyway, thank you guys so much. Thanks for listening. Thank you, Logan.